afternoon, everyone, and thank you very much for joining us today for this insightful edition of Arcview Access, where we're going to be taking a deep dive into cannabis investments and specifically the different funding options that exist, and probably a few in there that you and I haven't heard about yet. Today's format is also going to be a little different too, since we like to kind of spice things up here at Arcview. After our panel, we will be opening up a link for you to join a breakout session by topic. This is a way for you to interact with our panel, our Arcview entities, and others on specific areas of interest. So please join us after the scheduled webinar. And at the end of the show, make sure to grab the link that's going to be in the chat, because you're going to need this for this other part of the webinar. You're going to have to kind of get out of this one and then join that other Zoom instead. Sorry about that. That's technology for you. So the chat also, by the way, is open, and we want you to give us a shout out. Tell us who you are, where you're from, what about cannabis is really interesting for you. And you can also use that chat to ask questions of our panelists, which we are going to go ahead and take at the end. But you can also use the Q&A button there at the bottom of the screen too. So before we get started today, I wanted to give out another shout out today, and that's to our left coast friends, from our left coast friends to our right coast friends, and specifically to those of you in New York. Way to go and welcome to the club. And what I mean by that, for those of you who don't know, is that New York today just reached a deal to legalize recreational marijuana, a move that paves the way for a potential $4.2 billion industry with millions of dollars in tax revenue to be reinvested in minority communities each year. So it's going to take a little time, probably a year, to work through everything. But what is really incredible and important about this particular event is that many of us think it's a tipping point for full federal legalization. And if that is the case, then our discussion today on cannabis investments and vehicles is very timely. And if you're still on the fence, well, all I can say is it's time to jump. So without further ado, it is my pleasure to introduce our moderator today. Tracy Gygos is a partner at Duane Morris, and we are very fortunate to have Duane Morris as a distinguished member of our Arcview Alliance. So today, you're going to hear from Tracy and a group of panel experts around these investment vehicles. But just a little bit more about Duane Morris. So they have over 800 attorneys across the U.S., both here in the U.S. and internationally. And Tracy and her colleague, Michael Schwam, lead their cannabis practice. And as a team lead in their cannabis practice, Tracy acts as lead transaction counsel on mergers and acquisitions, financing transactions, roll-ups and regulatory, and compliance for cannabis companies at all stages. Tracy's been working in this industry since 2010. I can remember back in that day because that's when Arcview started. So she's been around for a long time, and her background and knowledge is extensive. Tracy received her JD from Drake and her undergrad from Berkeley. Tracy, welcome to the stage, and let's get this started.
Kim, thank you so much for the introduction. Good afternoon, everyone, and thanks so much for joining us today. Before we dive into the panel, let's give the panelists just a few minutes to introduce themselves, and I'm just going to start calling out people in the order that I see them on my screen. So let's start with Lara.
Hi, sorry, taking me a second to get back online. You surprised me. It took me. Thanks, Tracy, so much. My name is Lara Decaro. I'm an attorney who has been practicing in the cannabis business space for upwards of 15 years now. I do a wide variety of transactional work, no litigation, but a lot of what I do involves investor relations, and then also a lot on the social equity side of things. So I'm quite diverse. I'm also a co-founder of the International Cannabis Bar Association, the Bar Association of San Francisco's Cannabis Law Section, and the San Francisco Pro Bono Legal Services Panel for Social Equity Applicants. And that's just a little bit about me.
Great.
Thank you for having me. I'm glad to be here.
Thanks, Lara. Jay?
Hey, thanks, Tracy. Thanks, Kim. Good morning, everyone. I'm Jay Purcell. I'm a corporate and securities attorney based in Los Angeles. I've been working in cannabis since 2016, and before then I was a corporate and securities lawyer in Silicon Valley. I work with investors and I work with cannabis entrepreneurs throughout the state. And I'm excited to kind of keep working on this Cannabis Safe project. Like Lara, I've worked on both sides of social equity transactions and companies throughout California, and I think we're all eager to see them continue to grow in a challenging environment. Happy to be here.
Thanks, Jay. David?
Yep. Hi, everybody. My name is Howell from Meadow. I'm the CEO and co-founder. We started in 2014. We're based in San Francisco. We're the first cannabis startup to come out of Y Combinator. We also presented at Arcview in 2014. So been part of the family for a while. We build software primarily for dispensaries to help them sell more cannabis with less work. We're based in California. We work with about 170 dispensaries. And I'm also on the board of the California Cannabis Industry Association and the Cannabis Distribution Association. So all in on California over here. Appreciate everyone showing up.
Thanks. And I know a ton of my clients use Meadow, so thank you.
Yeah.
Khurshid?
Hi, everyone. I'm Khurshid Khoja. I am the principal and founder at Greenbridge Corporate Counsel. We are a transactional and regulatory boutique firm that has worked in the cannabis and hemp industries for about 10 years now. Before that, I was an activist going back to about 2001, 2002, and have served in many different roles in the industry. Currently, I am chair of the National Cannabis Industry Association board. Prior to that, I've served on the Minority Cannabis Business Association board. I've served as general counsel to the California Cannabis Industry Association. I've served on the board of the Emerald Growers Association, which later became the California Growers Association. And my very first interaction with the cannabis industry was actually as outside counsel to Arcview. I got to host their very first investor forum at my previous law firm. So really thrilled to be here. We represent, my firm represents a number of big publicly traded MSOs, as well as mom and pops still in the industry, OGs, and thrilled to be here today. Thank you.
Thanks, Khurshid. And last but certainly not least, we have Jason.
Had to unmute myself. Forgot about that for a second. Hello, everybody. I'm Jason Kornfeld. I'm a partner at Mayfield Venture Law. We are sort of go-to outside counsel to a lot of startups in the cannabis space, and our focus is pretty much that seed to B space. We do represent investors as well, and essentially our focus is really anything on the corporate and securities and commercial transaction side for companies operating from seed to B. My focus is largely more on company side, but as I said, we work with investors, and really excited to talk to, I guess, a nice group of everybody and discuss the perspectives around the intent of the SAFE and how we hope that you guys will leverage it moving forward.
Excellent. Thanks, Jason. Well, we have a lot of material to cover today, so let's just get right into it with the first question here, which is, what investment vehicle types do operators or investors prefer? And let's start with Jason on this question.
I think it depends on the stage of the company. In my practice, I have very rarely, I think maybe one out of my many clients is using at the seed stage, right? Is using a convertible note at this point. You still see them, but generally speaking, it's all safes. And the reason being for that is it's just much more practical for just really early stage companies, how long it takes them to go and raise a priced round. And just there's a lot more legwork in negotiating convertible notes compared to a safe. It's a little bit easier just to pull off the shelf and just kind of get back down to what the founders do best, which is just making sure that company can scale and get to that first equity round. Usually we see convertible notes more in sort of like a bridge situation. But we still do see them in the earlier stage market as well. Just kind of depends on oftentimes what the investor is most comfortable with. And obviously as you get closer and to more of, we're like a real business making real revenue, that the equity round starts to come in. And the really, oftentimes, even with like early stage companies, though, we do see equity rounds happening a lot earlier. And it really just depends on how much money is being raised and the kind of investors you're raising it from. So yeah, I think it's kind of all over the map, but generally speaking, the two factors that I guess would be differentiating here as to what kind of instruments being used, whether it's debt, equity, or a SAFE, which is essentially like a debt instrument, but carries no maturity date or interest, and for tax purposes is actually also treated as equity. It really just depends how much money is the company raising and who are they raising it from.
Okay, great. Do any of the other panelists want to chime in before we move on to the next question? Okay, so Jason, you already kind of mentioned this in your answer to the first question, but what are some of the pros and cons of the Safe Note versus other types of investment vehicles that we're seeing in the space? You mentioned that they're generally easier. It's kind of more pull them off the shelf type rather than convertible notes. But what else makes them better?
So, I mean, like the SAFE was really designed to be used with, earlier stage companies because it's really not intended to be an instrument that's negotiated heavily. Like I said, it's meant to be pulled off the shelf, and really all that should be negotiated are sort of, what form of SAFE you're using, whether it's just going to be people in the audience, you might have heard of like a valuation cap, a discount, or a mixture of both, something like that. And that's really all that needs to be negotiated with in connection with the SAFE financing. Once you start getting into a convertible note, now you're adding in the complications of, okay, we have interest accruing, we're negotiating a maturity date. What happens on that maturity date? Can the investors force the note to convert into equity of the company, or could they keep it outstanding, or do they have a right to demand repayment? So a lot of those kinds of complications that can arise with a convertible note make it more expensive for companies to negotiate out the gate. And two, it can, let's say you raise 20 convertible notes or 30 convertible notes, right? And you hit your maturity date, you haven't raised an equity round. Well, now you got to deal with the added legal cost of maybe extending those maturity dates, or hoping that if you don't want to pay a lawyer to help draft those things up, that your investors aren't going to try to force convert into preferred stock and then negotiate, what that preferred stock is going to look like. And it can just be messy. So I think the whole point of the SAFE is really like everybody's working toward the same goal of, we want this to convert in an equity round. We don't really want to force convert this into, preferred stock of the company and take control before, you raise your first equity round. So just, here's our money. We believe in you as a founder, and, prove us right is essentially what the SAFE is saying. I think a lot of investors, the reason they don't like SAFEs, and I'm sure some of you would probably agree with me, maybe you disagree with me, is you're not technically, like, it's not a secured debt instrument on the company. It seems a little bit riskier because you're not carrying interest, and the forced conversion is something that you actually might like. I just think it's, in the early days, it just creates a lot of noise and distractions around, negotiating early stage investments that people really shouldn't worry about, because, if you're raising like 500 grand out of super low valuation, realistically, like, you're probably not going to want to convert that money into the company and force conversion of it. Because if they're not able to raise after a few years or 3 years, even at a valuation that's even close, let's like just hypothetically, right? Let's say it's you're able to invest on this company at like a $2-3 million valuation cap. If the company is not able, like the best they can raise a price round at is like the same thing or something like that, I bet you the company is probably going out of business anyways. So I think it's kind of unnecessary sometimes to really like drill down on the finer details of what a convertible note brings versus a SAFE. Because at the end of the day, the conversion mechanics themselves are exactly the same. It's just that you don't get the kicker of interest at the end of the day. So yeah, I don't know, Tracy, if you want to ask me specific questions as to like to pull better details out of me, more than happy to field those. But those would be the main reasons why I think the SAFE has become a much more popular instrument.
Okay, well, let's talk about the panelists' individual experiences using or preparing SAFE notes for clients, or actually being a party to a SAFE note. Let's start with David.
Yeah, sure. Yeah, I guess if I follow the journey from our first pitch at Arcview in 2014, we were fortunate enough to get into Y Combinator for the winter class of 2015. And we graduated in March, and that's when we started raising our seed round. And we used a safe. It's what YC sort of created for everyone. It creates standard terms. And I'm happy to say that our mentor at Arcview at the time was Poseidon Asset Management, and they ended up signing on, which is cool. They were one of our early checks. And I think to Jason's point, the timing of maturity is really helpful for founders because we've just been working on our startup since then. And so, we raised our seed round with over about 50 different investors. We did $2.5 million at around the $12 million valuation. So those terms were set. It was interesting. We took checks as small as $5,000 to $250,000. And it was a 9-month sort of conversation, whirlwind, but it was a really great chance to meet investors and really kind of get to the core of what we're doing and what we're pitching and what we're trying to build, then try to negotiate terms. And so I think the SAFE really provided just a neutral ground to set these terms, to not have crazy amount of lawyers, to not have to set really 2 numbers and then get the signatures and the checks wired right there and then, without having to wait for the full equity round to close and then the wire. I was able just to get this rolling round going as we each signed these safes. So here we are now. It's like 7 years in, which is kind of crazy for everybody that's been in this for a bit. I salute you. And when we are looking at one of the things that I was talking with Kim in one of our panels was to build great companies, focus on the core pieces like revenue, hitting profitability. And so for us, we're going to probably hit profitability this month, which is great. And we're also going to go raise our Series A next month, which allows us to then allow all of these people that have been with us for the entire time to then convert into equity in that A, which I'm pretty excited about. But I think it's one of those things that I didn't have to worry about maturation dates and interest and all these other things that would have detracted us from just building a great product. So those are the 3 things really around standardization, time, and money, where it comes down to it, that helps us with the SAFE.
Thanks, David, and congratulations on the Series A. That's very exciting.
Well, yeah, that would be just like when we're going to go after it. We'll see. That's why I think there's a lot of action going on. There's a lot of excitement, so might as well grab the bucket while it's raining.
Absolutely. So for the other attorneys on this panel, what have your experiences been with your clients in terms of preparing SAFE notes, and what have your clients' experiences been with them? How about Lara?
Hey, okay. So, in my experience, it's been a welcome shift from a traditional use of convertible debt, right, over to the SAFE. And so it was actually a really welcome change for everybody involved, because the people that I work with tend to work with traditional investor types on large scales. And those traditional investors tend to come from more traditional legal environments with more traditional law firms. And so they're used to seeing a certain type of vehicle, and it was something that they could identify with. And so it made our jobs a lot easier. And like Khoja said, we were able to step back, and we weren't required to put in so many hours of attorney time to get something to close, simply because I think it was something that the lawyers were used to seeing, the investors were used to seeing, and everybody was comfortable with implementing pretty quickly. So,
okay. And let's just hear from one more panelist. Jay, what has your experience been with your clients on SAFE notes?
Thanks, Tracy. So I think David made a really good pitch without knowing it. He said that the company raised a lot of money over about 9 months, and there were large investors and small investors. That's a great use of a SAFE, right? Over several months, he kind of keeps bringing in investors on the same terms, without having to amend his articles of incorporation to create additional stock or to create stock with a certain liquidation preference. When Jason talked about the price round, they're great, but they just require sort of more mechanics. So if David had had to do a priced round every time he took a check, it would have been madness. That's where the SAFE is great. Where I've seen SAFE not be great, and this is sort of something that Jason touched on before, there's a lot of, I think, confusion about valuation caps and what they really do. I think we always tell our clients, think of the valuation cap as P divided by C plus P. So principal divided by cap plus principal. That is what an investor knows is the least amount of ownership he or she is going to have in the company. Like, that's the benefit of the cap for the investor. It's the smallest amount of the company I'm going to own. The trouble that folks get in is, as the cap gets lower and lower, they wind up just doing normal financings without realizing it. If the cap, like Jason said, we're set at $2 million and you raised $1 million in SAFE, you've sold a third of the company without really intending to. Like David said, it's great with have a SAFE and sort of keep selling them to lots of interested parties, 50 here, 120 there. They're great to raise lots of money from many smaller investors. But we've all seen cases where the Series A comes, everyone's excited, and the company finds out that the stakes are going to convert into 30% of the company, something large. We've seen clients find out that the Series A will cause them to lose control of the company. So the story with valuation caps is, if you're an investor, you want the valuation cap to be $2 or $3. If you're the company, you want the valuation cap to be infinity. And to just try and always keep that equation in the back of your mind, P divided by C plus P. That's the amount of company that is going to be sold, at least to the investor. I think that's the first thing that comes to mind, Tracy.
Thanks, Jay. Let's move on to the next question here, which is, what are some regulatory nuances that affect cannabis investments that don't necessarily affect fundraising in other industries? And let's go to Khurshid for this one first.
Sure. So there are a number of issues that can come up with respect to cannabis investments, and oftentimes you'll see these noted in well-drafted investor disclosures issued by companies that are trying to raise money. And it's worth noting that none of these are really insurmountable obstacles, and you know, I think all the attorneys on this call would be able to help you navigate them, whether you're a company or an investor. But that being said, at the state and local level, there are laws and regulations that limit the size of the stake that you can take. As may be the case with certain investments in social equity businesses, where the social equity applicant has to maintain a certain threshold of ownership to maintain that social equity status. And oftentimes that's a majority stake, but not always. It depends on the jurisdiction that has the social equity program in place. So, but oftentimes, if you're an investor, you can't necessarily take a majority stake in a company, even if you want to. There are other state and local laws requiring notices to regulators and licensing agency approvals as well when new investors are added to the cap table. And even with some non-equity investments, taking a profits interest, even making a loan or entering into a SAFE as well is something that may have to be disclosed to the regulator as well. And so, oftentimes that's different from what investors who have invested outside the cannabis industry have experienced. So there are mandated investor information disclosures, criminal background checks that are required to obtain those regulatory approvals. Continuing owner requirements. In a lot of states, licenses are non-transferable. And so if you're going to have any kind of investment into a cannabis company, the regulators are on the lookout for what they think are disguised license transfers, right? And so you have to deal with, if you're coming into a company and investing in a company, you may have to keep some of that team in place as well, and that may not be something that you're necessarily expecting. There are cross-licensing ownership restrictions as well. So, like if you're invested in a testing lab, right? If you're already invested in testing lab, that may restrict your ability to invest in other businesses, a distributor, or manufacturer, or retailer. In California, that's certainly the case, and so that's also similar in other jurisdictions that want to maintain the integrity and independence of the testing labs. I think it also bears repeating that even though we're very, very excited about the developments in New York and now a majority of states have some form of legal cannabis in them, cannabis is still federally illegal, right? And so the Controlled Substances Act is still there, right? And so in addition to the criminal penalties, there are kind of practical things that you don't necessarily think about as an investor if you're willing to accept that risk of, hey, okay, yeah, this is still federally illegal, but I see the way the wind is blowing and I'm not so concerned. You might be more concerned if you find out, well, once I get my distribution check, I may not be able to deposit it in a bank, right? There are only certain banks that will work with the cannabis industry. There are very strict restrictions that the Department of Treasury has put on them as a matter of policy as to, who can take and bank cannabis businesses and cannabis investors. And so that's something that not every investor is necessarily prepared for. And then there's even things like federal immigration and border control policies that may impact the immigration status of U.S.-based investors that are non-citizens, and even foreign investors, right? And that can impact their ability to enter the U.S. if they are a cannabis investor. And unfortunately, Arcview has experience with this because I think the first time that this happened, where Customs and Border Patrol basically gave a lifetime ban to a cannabis investor coming in from Canada, they were on their way to an Arcview meeting, and this was a very, very well-esteemed, legitimate investor, squeaky clean, very nice guy, and well-known in Canada in the investment community. And so it didn't matter. He unfortunately has a lifetime ban now. And, so those are the types of regulatory hurdles that are still there. Again, by no means insurmountable. But if you're new to cannabis investing, these may come as a little bit of a shocker to you. So something to keep in mind.
Thanks, Khurshid. Those are obviously a lot of different issues that we see in cannabis investing that we don't see in other sectors. And you covered a lot and gave a few examples. For the other attorneys who are on the panel, can you talk a little bit about some hurdles that your clients have experienced? Like, for example, Khurshid brought up disclosure issues. And for me, a lot of the investors I've worked with before have had issues with being disclosed as either an owner or a financial interest holder on a California license. So let's talk a little bit about, just for a few minutes, what are some specific issues that your clients have seen? And let's go to Jason.
So, on the regulatory side, I would say oftentimes it's, people who want to try to avoid being disclosed to regulators. And I've had to deal with at least one financing where we had to fully restructure the company because the lead investor was so paranoid about this, and it was absolutely not necessary. And I remember just being on calls we had our regulatory counsel, they had theirs. And even after the deal, I talked to the regulatory lawyer and she told me, she was like, we didn't need to do it, but they were so paranoid that they had to do it their way. And it was just really interesting to see that, because I think once you get into, you never know, even if people say like, yeah, I've invested in cannabis, I know the regulations, I still seem to run into everybody who, when it all push comes to shove, they have their interpretation as to how things are going to play out or how they thought things would play out. And trying to get ahead of that as early in the process. So that was our nightmare situation, right? Where we had to like fully spin out an entity, and it was a real mess. But I think like that's where we were getting at with the Cannabis Safe, is just really trying to make sure as much disclosure as soon in the process as possible to make sure everybody's on the same page about what the company's expectations are going to be versus what the investors' expectations are going to be, because they can potentially think that they're aligned, but they're not when it comes down to being like, hey, we're ready to go ahead and like, we need this information from you. And they're like, wait, yeah, in theory, you should have to do that, but we don't think you have to do that. We don't want to do that. So, because you never want the regulatory issues to be, if you can avoid it, to be the things that slow down getting the money in the bank.
Right.
So I think that was probably the worst situation that I've had to deal with. That was like a hair pulling out moment. So yeah.
We have a lot of those, I think, as lawyers.
Right. I know. I had a similar situation in Europe with an investor who had a lot of other investments around the globe and was very legitimately concerned about his information being subject to a FOIA request or some other disclosure requirements, right? And now, last leg session, the state of California passed 1525, which essentially provides financial institutions the ability to grab a lot of licensed data and anything that's in metric aside. So there is a real viable concern about what's going to happen with that data and the confidentiality surrounding the investor's information. So I can see why people are concerned. I think that there are plenty of ways to manage it. And as a lawyer who's been working in the space and has done a ton of applications, and I think, Jay and Khurshid, Jason, all of us could advise people on how to help minimize any risk. But there are very real risks. And if your, partners in another venture see that you have this cannabis investment, there can be some negativity and stigma associated with that. So that's a very real concern. But also it can trickle down to other licenses, security clearances for government positions can, this is not a necessarily popular topic, but a gun ownership right now, obviously it's still an issue with owning a firearm in the United States. So there are a lot of considerations, I think, with regard to just the privacy around those disclosures themselves. On top of that, there are basic things like, how is this company organized? Like, are they an LLC or a corporation? And, how are they taxed? And then, adjusting investor expectations based on Internal Revenue Code provisions and the personal liability that might follow that. I actually had one investor group that was adamant that the target company be an LLC because they wanted the pass through, even though there was risk of some potential for personal responsibility for tax bills because they had so much money that they wanted to take it back and reinvest it anyway. And they were like, we can cover whatever the tax liability is going to be. So, you really have to know your investor and what their concerns are and be able to walk them down just like from A to Z. Sort of everything is involved.
Absolutely.
Yeah. If I could add one thing, I think from the company side, one thing companies can probably do to make the process a little smoother. So lots of cannabis companies are still organized as multiple LLCs and multiple corporations operating with each other. And when it comes time to do a deal, that's always a not. I've done deals across from Tracy and across from Lara where there might have been a dozen different entities and different founders own different pieces. I'm doing a deal now where there's 4 companies in Los Angeles and they're having trouble identifying how much each one owns. So if you're a cannabis company and you're operating out of, this is a really good investment to talk to a lawyer, to sit down with a lawyer and say, here's how we've been operating. Can this be simplified? It probably can. I know tons of companies that have an IP holding company, but they don't have any valuable IP, right? It made sense at some point, but now it's just sort of an expensive appendage. Think about simplifying, think about consolidating before the investor comes. And you might save some time and headache.
Yeah, Jay, I think the last deal that you and I worked on together, I think maybe end of 2019, we had multiple. I can't even keep track of all the LLCs that we had.
Exactly. Yeah.
Well,
you got it.
a good piece of advice. Okay, so let's move on to the last question here. There's been a lot of information that everyone's given here on the panel. And let's say that in the audience, after hearing everything that everyone's had to say, someone who is participating on this call right now realizes they're in a really badly structured deal. What can they do to unwind the deal? Let's start with Lara on this one.
Run away. I'm assuming we're talking about getting out of your investment, whether you're an investor or the company, and not like typical unwind, on the investor term, like advanced unwinding. Right. But so I guess, from, an attorney's perspective, right, my first gut reaction is I'm going to go to the deal docs. I'm going to see kind of what was signed. And that is kind of one of the beauties of the SAFE, right? Which is that it allows you that dating period. And if you really figure out that this isn't going to work out for whatever reason, it's a personality clash, it's an information clash, there's probably a bit of a higher likelihood that you're going to be able to get out of it without getting married. And, so I do like it for that, but I would want to look at, what is the company exit strategy? How is that put together? I would want to look at, my own personal or my client's exit strategy. I would want to look at the definitives, whether there's, an investor rights agreement or a stock purchase agreement or anything like that out there. Just try to ascertain what the paper looks like. And then, if there's nothing on paper that lets you sort of modify the deal, obviously you don't want to go back and retrade what you've done, but there may be some political climate that people need to focus on that can help pivot the organization in a way that makes it, just maybe more attractive to some rather than others to either part ways or to change the focus or how the organization is being modified. There are actually a number of dispute resolution organizations that are picking up on cannabis, doing a lot of work in cannabis, and may be worthwhile starting down that road. But those would be the way that I would think about it. And then also, when you're looking at your documents, thinking also about like how this is going to affect you on a tax basis. You're going to need to be advising the client on what this will look like if they do withdraw it now from either aspect. But yeah, other than that, I mean, it's like any other business, right? In terms of unwinding the transaction, as far as I see.
Yeah. I think, you can look at termination clauses, obviously, in the definitive agreements, as Lara's mentioned, that's the first place I would go to as well if I was advising an investor. But there are a lot of still, unfortunately, a lot of handshake deals that are being done, right? And people coming to you and saying, oh, I've known so-and-so for 10 years and we've never had an argument ever. And we've all, so we know what we're doing here. We don't need all this paper. It's too expensive. We don't want to do this. Just this is what we want, right? And so some lawyers will actually cater to that, to their great dismay later on. And you have situations where there are no definitives sometimes, right? And I think that in that situation, maybe you rely on material omissions, right? If you say, well, I wasn't told that this was, so-and-so told me this is all federally legal, or that, that no one told me about these banking issues. No one told me about 280E. No one told me I'd have to be disclosed to the regulators and have to have a criminal background check. That is potentially a basis as well for claiming, hey, this is a securities transaction and this is a material omission. I wasn't told about this, and so I'm out.
Great, thanks, Khurshid. How about Jay or Jason? Any thoughts on what you would advise to unwind a bad deal?
I mean, it's tough, right? Because every situation is going to be different. I will have to say that I think I was mentioning to you guys on our pre-call. I think I'm on probably the craziest deal that should have been unwind of my career right now. And weirdly enough, that's going to work out and end up going through. But people did try to unwind it for a bit, and it's not like it's a simple process, right? Where especially once you've gone through multiple rounds of financing, there's so many different people involved and personalities, and everybody's got a different interest as to what they would like to see happen. So I think like Lara was saying is, go to the definitive docs. If you're, investor counsel, you're probably going to largely be looking at the disclosure schedule to see like did they really forget to just tell us about a whole bunch of problems with the company? But the really nice thing about the SAFE is it does allow for a dating period. It's a pretty informal document. I mean, to be honest, it's probably gonna be pretty hard to get your money back though if you decide like, hey, this company, whether it's a note or a SAFE, even if you hold the debt, if the money's gone, the money's gone, and it's gonna be pretty hard to get that back from an early stage company where they spent the money and it just didn't work out. That's part of the reason why the SAFE has become so much more popular, right? It's just much easier to negotiate, and you're really just getting behind the founder and the idea of this early stage investment. And there's no point in sort of like really trying to put your tentacles in, because at the end of the day, it's really just, we're all hoping this succeeds. And if it doesn't, then we just go our separate ways. So we don't really see, at least on like the early stage investment side, those investments being unwound too frequently, because largely the money's not really there. Sometimes we will see it where maybe there's just a huge pivot in the company and founders sort of go their separate ways. And so you will be negotiating with investors where it's like, would you like to hold equity in the new company, or do you just kind of want to walk away from this? And so, I think at that point you can maybe find yourself in a place having a little bit more leverage from the investor perspective. But yeah, generally speaking, I think it's largely depends on what kind of documents we're trying to unwind and your relationships with the founders versus investors and how things are going. Because at the end of the day, right, everybody wants it to succeed, depending on how far down the road you are and into the chasm. But yeah.
Thanks, Jason.
I think I would cheat and answer a slightly different question about just keeping your investors' expectations realistic. I hear companies of all sizes talk about going public, and that's just not realistic for most of them for tons of reasons. It's not realistic for almost every company to go public, right? So I want to answer your question by saying ahead of time, be more realistic with your investors. It's difficult to sell and be, super serious about likely outcomes, but we've all seen deals where the client has a slide showing that, they're going to have $10 million of profits by 2022, just,
Yeah.
because, and that would be awesome. But the cannabis market's really difficult. It's a really difficult business. If you can be honest with your investors about how difficult and troubled and challenging this will be, maybe they'll expect the pivots, right? Maybe they won't feel heated if they know how complicated this is going to be. So scare your investors early so that when things go crazy, they'll be patient, they'll be calm.
Right.
Yeah.
Okay, well, before we wrap up, I do want to hear from David as the non-lawyer in the panel. What would you do if you found yourself in a really bad deal? What would your first move be?
Call my lawyer.
Good answer.
But I think a better option is try to prepare for all those scenarios beforehand and try to create a structure that nurtures your company for success. One of the number one killers of startups is founder breakups.
Right.
Founder breakups happen. People, some are amicable, some aren't. And having vesting schedules with your founders to make sure that if someone does leave, they just don't get 20% of the company. You've earned it over a period of time. Setting up an option pool, making sure that option pool is utilized for your early employees and your people so everyone can share on the upside. We often find that, startups are just incredibly hard, and although I agree that investors, you want to be pragmatic, at the same time, you have to sell the dream of what you're going to build and create a distortion field that drowns out all the noise, and you're just going to build this thing and you have some desire or willpower that's going to make it happen. And I also think a lot of people tend to chase these vanity metrics or this amount of money, or I want this investor. And At the end of the day, like money is just fuel. You building your rocket ship, it's just fuel to take it into the stratosphere. It's not your identity. It's not anything besides that. But with that money, it's like a responsibility to be a good capital steward. And part of that relationship with the investors is like them being on your cap table. It's like for life almost. It's like marriage. You really have to vet who you're getting in bed with and make sure they understand what's going on and they're aligned and they're not going to cause problems or request all this information and just kind of be on you on stuff where it's just like, dude, I just want to build the company. Like, leave me alone.
Right.
We've seen that. We've seen that happen with a lot of companies where some investor decides to be like now an active operator. And you're like, no, you're there's the money, man. Like you're the money, the network and the relationships and like you're a therapist. Like those are great. If you can talk to them like honestly about things, that's good too. But I think you're really getting yourself set, structure these things, make sure you're set up well so you don't have these problems down the road that many startups do.
Great. Thanks so much, David. And thank you to all the panelists. That was a lot of information in a very short period of time that we got out there, which I hope was helpful to the attendees. We're now going to pass it back to Louis for question and answer session.
Hi, everyone. My name is Louis, and I'm one of the VPs here at Arcview. I've been with Arcview since 2015, and I've seen thousands of investment decks and business plans from across the industry. A lot of what the panelists have said here, all the crazy breakup stories and the outsized expectations and best practices and not so best practices, I've seen it firsthand myself. So thank you for all of your insights. Let's get to it. First question, I'm going to have Khurshid and Lara start this off, and everyone else, please feel free to chime in. Let's talk about the safe note, and maybe even the cannabis safe note specifically. So the California Bureau of Cannabis Control, as well as other states, has this term around a financial interest. And if an investor has a financial interest in a business, then there's all these reporting requirements that was talked about earlier. Does the safe note or the cannabis safe note, that variation, work around that? Or does, even with the safe note, the investor needs to be identified and background checked and all that? Also, does a financial interest in a technology company like Khoja, that doesn't touch the plan at all, do these same regulations apply to these software businesses, or is it just plan touching?
Okay. That's not deep at all. Hey.
Real surface level.
This is not legal advice. I got to say, I've not been retained. I am not your attorney. But I mean, my guess is, right, if for tax purposes, the safe is treated as equity, you're an owner. I mean, if the Bureau is going to follow the money the way that the, taxing authorities do, you have to, likely have to abide by the ownership disclosures, not the financial interest holder disclosures. Now, I don't necessarily believe that's a sealed and signed question that's been, settled by the Bureau itself. But I definitely think, Jason might actually be our best person to answer this particular question insofar as that part is concerned.
So, before Jason jumps in, so I would say that I do think it's actually a financial interest disclosure. I don't think it's necessarily an ownership disclosure. One, because there's no equity to be held yet, right? And so there is a threshold at which you become a quote unquote owner. All investors essentially are going to be financial interest holders, whether you are making a loan, you're entering a safe, you've got a less than 20% equity interest or a less than 20% profits interest. You are deemed a financial interest holder. You have to be disclosed in California. So that means, you're giving up your name, your birth date, and a government ID number, right? Your driver's license number, passport number, something to identify yourself to the regulators. But you're not subject to the full, proctology exam, the full ownership submittal, and criminal background check. You're not being fingerprinted at that point yet. And so that is one of the advantages, perhaps, of a safe, is that you're not immediately subject to ownership requirements. Now, when you convert, maybe a different story, right? You may pass that threshold at that point. And it's also kind of, confusing, to regulators who, a lot of these folks are good regulators and they know cannabis, but they don't necessarily know securities law or corporate law, right? And so they will look at a safe and, they will see in the safe, well, this is kind of treated as equity for tax purposes. And so they will assume, well, it's equity then, right? And they're not necessarily equipped to know the latest and greatest about the investment climate and what instruments folks are comfortable using and how they are used. So that's been kind of my experience.
Right? I mean, that's like kind of the mental gymnastics I went through initially, which was, okay, but they don't really know, so you have to be able to prepare for both, I think, scenarios. I don't think it's a settled question. And I do think it's something that we need to flesh out a little bit better as an industry. Insofar as the second component of the question, if you're not associated with a licensee, ancillary or non-plant touching businesses don't necessarily have to be disclosed. They're not subject to the same disclosure requirements, but you have to keep in mind you cannot conduct commercial cannabis activity with a licensee if you are not a licensee. So you likely will end up being disclosed to the regulators at some level at various stages of their licensing process.
Got it. Thank you. I'm going to take a small step away from the investment topic and talk about 280E, since that was mentioned a couple of times. People have been asking in the Q&A, it's with tax season sort of upon us, at least for personal taxes and safe banking being reintroduced at the federal level. From all the attorneys on the call, Tracy, yourself as well, if you have any insight here, how has 280E action by the IRS evolved over the last maybe year or two? Increase, flat, decrease? What sort of trend are you guys seeing? Jay, I saw you do a up movement.
Well, I'll follow Tracy.
I was going to say it's been flat for us, for our clients. We haven't really seen any movement in terms of 280E. We're still seeing the same issues we saw, 3 years ago when adult use cannabis first became legal in California and in other jurisdictions. It's so far there appears to be no difference, and it really just depends on the transaction we're working on and the corporate structuring for a particular client. There tend to be more problems, as Jay said earlier, the more entities you have. So with that, I'll let Jay go ahead and chime in.
Thanks, Tracy. I guess when I set up, I was thinking I see a lot more litigation around it, which I take to mean lots more companies are losing their audits with the IRS in such dramatic ways that they're willing to spend a lot of money to litigate them. The cases I'm following, there's Ninth Circuit cases, the cannabis company always loses. The management company always loses. I feel like the IRS's interpretation hasn't really changed, but at least the companies I'm working with, they are more and more finally getting audited. And I think they are slowly accepting that 280E really does apply to them in the same way with financial interest holders. Like Jason said, everyone sort of has an argument for why they shouldn't be. I feel like most cannabis companies have an argument for why 280E shouldn't, but the IRS says no to all of them, it seems. 280E is a monster.
Highlighting the importance of having good attorneys on your team and setting up your company right in the first place. And call your Congress people. We've got safe banking. We've got a Congress and an executive office that's very warm to the idea of federal legalization. It's one way that we could do with 280E is by showing political support as well.
A good accountant helps too, just to throw that in there. Having a skilled accountant that knows the industry, knows how to characterize things legitimately as COGS, I think is invaluable.
100%. Well, I think that's all the time that we have for questions. Thank you so much to all of our panelists. And Tracy, thank you so much for moderating the main talk as well. So I'll see you over on that next breakout session, and looking forward to seeing you over there. But thanks so much, everybody.